Picture this. While everyone's been obsessing over Bitcoin and gold, something extraordinary has been happening in the silver market that almost nobody is talking about. China has been quietly accumulating silver at a pace we've never seen before. And if you understand what's coming next, you might be witnessing the setup for the biggest wealth transfer in precious metals history. In the next 7 minutes, I'm going to show you exactly why silver could be heading to $100 per ounce, and why the $25,000 margin requirement might be the nuclear trigger that sets everything in motion. Stay with me, because what I'm about to reveal could change your entire perspective on wealth preservation. Let me start by painting the real picture of what's happening behind the scenes. For the past 3 years, China has been systematically buying physical silver through back channels that most Western analysts completely miss. We're not talking about official government purchases that show up in reports. We're talking about state-owned enterprises, proxy companies, and strategic stockpiling that's happening under the radar. Industry insiders estimate that China has accumulated somewhere between 300 million to 500 million ounces of physical silver since 2022. To put that in perspective, that's roughly equivalent to 6 months of global mining production just disappearing into Chinese vaults. But here's where it gets interesting. China isn't doing this for investment purposes or because they think silver is pretty. They're doing it because silver is absolutely critical to their technological and industrial dominance. Every solar panel, every electric vehicle, every 5G infrastructure component requires silver. China is the world's largest manufacturer of solar panels, producing over 80% of global supply. Their commitment to renewable energy isn't just environmental posturing, it's strategic industrial policy. And they've realized something crucial. Whoever controls the silver supply controls the future of green technology. This isn't speculation, this is game theory playing out in real time. Now let's talk about the supply side of this equation, because this is where things get truly explosive. Global silver mine production has been essentially flat for the past decade, hovering around 800 million to 850 million ounces per year. Meanwhile, industrial demand has been climbing steadily, and we're now in a structural deficit where annual demand exceeds new mine supply by over 200 million ounces. That deficit has been filled by above-ground stockpiles and recycling. But here's the problem. Those stockpiles are depleting rapidly. The Silver Institute's latest data shows that identifiable silver bullion inventories have dropped by 30% over the past 18 months. We're literally running out of readily available physical silver. The situation gets even more critical when you look at the mining economics. Silver is primarily a byproduct of other mining operations, with about 70% coming from copper, zinc, and lead mines. This means silver production doesn't respond quickly to price increases the way a primary metal would. Even if silver doubles or triples in price, you can't just open new silver mines overnight. The lead time for a new mining project is 5 to 7 years minimum. We're locked into current production levels for the foreseeable future, and that creates a supply constraint that cannot be solved quickly, no matter how high the price goes. Here's where the $25,000 margin requirement becomes the nuclear option that could send everything vertical. For those who don't follow the futures markets, COMEX silver contracts are the primary mechanism for price discovery and institutional trading. Right now, the margin requirement to control one COMEX silver contract, which represents 5,000 ounces, is relatively modest at around $8,000 to $12,000 depending on market volatility. But exchange rules allow for emergency margin increases during periods of extreme price volatility or market stress. If silver starts moving dramatically higher and margin requirements jump to $25,000 or more per contract, it would effectively price out a huge number of speculators and leveraged traders. Now you might think higher margins would suppress the price. But here's the twist. It would force massive short covering and contract liquidation by traders who can't meet the higher capital requirements. The silver futures market has historically had a significant short position from banks and institutions using it for hedging and speculation. If those players are suddenly forced to close positions because they can't afford the new margin requirements, they'd have to buy back their short contracts in a market that's already tight on physical supply. This creates what's called a forced liquidation event, and in a market as small as silver, it could trigger a price spike that feeds on itself. Every dollar higher forces more liquidation, which pushes the price even higher, creating a feedback loop that's nearly impossible to stop once it starts. Let's talk about the path to $100, because this isn't just hopeful thinking. It's based on fundamental supply and demand dynamics combined with monetary policy realities. Silver is currently trading around $29 to $32 per ounce, depending on the day. To reach $100 represents roughly a 3x move from current levels. That might sound dramatic, but consider this. In 2011, silver briefly touched $50 per ounce. Adjusted for inflation, that $50 peak would be over $68 in today's money. So we're actually talking about silver reaching levels that, in real terms, it's already proven it can achieve. plus some additional premium for the supply constraints we're now facing. The fundamental case for triple-digit silver rests on three converging factors. First, the industrial demand story is accelerating, not slowing down. Electric vehicle production is projected to triple over the next 5 years, and each EV uses roughly twice as much silver as a conventional vehicle. Solar panel installations are growing at 15 to 20% annually. 5G infrastructure build-out requires massive amounts of silver for connectivity and electronics. This industrial demand is price inelastic, meaning manufacturers will pay whatever they have to, because there are no substitutes that work as well as silver in these applications. Second, investment demand is still at historically low levels compared to the peaks we saw in 2011. If we see even a modest return of investment buying from retail and institutional players, that alone could add 200 to 300 million ounces of annual demand to a market that's already in deficit. Third, and perhaps most importantly, is the monetary dimension. Central banks around the world have printed trillions in new currency over the past 15 years. While inflation has moderated from its recent peaks, the long-term trajectory for fiat currency purchasing power remains downward. Precious metals have historically been the escape valve for currency debasement concerns, and silver offers leverage to gold's moves while being far more accessible to average investors. If we see another wave of monetary expansion or a crisis in confidence in paper currencies, silver could see investment demand that dwarfs anything we've experienced before. Here's what I think happens over the next 12 to 24 months. China continues its quiet accumulation, further tightening physical supply. Industrial users start getting nervous about securing future supply and begin building larger inventories, which accelerates the drawdown of available stockpiles. Exchange inventories drop to critically low levels, triggering delivery concerns and pushing more buyers toward physical rather than paper silver. At some point, probably triggered by a geopolitical event, or simply the math of supply and demand becoming undeniable, silver breaks above $40. That breakthrough brings in momentum traders and retail investors who've been watching from the sidelines. Trading volumes explode, volatility spikes, and the exchanges raise margin requirements to $25,000 or higher. This forces liquidation of leveraged positions, creating the short squeeze that sends prices vertical toward $75 to $100 in a matter of weeks rather than months. The Chinese takeover of silver isn't a conspiracy theory. It's strategic industrial policy playing out in plain sight for anyone paying attention. The $25,000 margin requirement isn't happening today, but it's the inevitable response to the volatility that's coming when this powder keg ignites. And the path to $100 isn't about speculation, it's about mathematics, physics, and the reality that you can't print silver the way you print currency. This is happening. The only question is whether you'll position yourself before the crowd figures it out or after. Thanks for watching, and I'll see you in the next one.